M&G Investments Optimal Insights, brought to you by M&G Investments Intelligence Connected.
Thanks for joining us on Money FM 89.3. Now, looking back, 2024 was an eventful year, with the world seeing a record number of global elections, conflicts reaching new heights, a Japan flash crash, and not forgetting a normalization of interest rate cuts. Now, as we step into 2025, global financial markets are facing unprecedented levels of uncertainty as shifting economic growth patterns continue to challenge investors to rethink traditional investment strategies. However, in times of market turbulence, the right bond strategy oftentimes can offer stability and opportunity. For more insights, we are joined by Pierre Chartres. He is the Investment Director for Fixed Income at M&G Investments. Pierre, thanks for joining us today.
Thank you for having me.
Great to have you on because you want to talk about what to do with your investment portfolio. So looking back over the last couple of months, we've seen Fed rate cuts, and that's amid inflationary pressures. What is your assessment on the biggest challenges facing investors going into 2025, and where are you expecting the fixed income market to head towards in the coming months?
Yeah, I mean, as you did point out, it has been, to some extent, quite an eventful year last year. And I think the broad story is we did see a normalization of monetary policy, across the world at different paces in different regions. But central banks had been removing some of that restrictiveness that we had seen with high interest rates all over the world. So that kind of went as expected. What has been a little bit unexpected or going into 2025 is that can those interest rate cuts continue, as you pointed out, because inflation has been, stubbornly persistent and the cost of living remains quite high. And if you look at bond investors, they look at the Fed and they think, well, the Fed's cut interest rates by 1% last year, but they're a bit skeptical that central banks will be able to continue at the same pace of rate cutting. And that's the challenge. But broadly speaking, we're still quite constructive on fixed income. If you think interest rates are still high, yields are high. I mean, U.S. Treasury yields at 4.6% in our view is quite attractive from a risk and reward perspective. We think inflation is going to continue to come down closer to the 2%. Yes, it's taking a long time, but we think we're moving in the right direction. We think monetary policy does work, and that will reduce the amount of economic growth in the U.S., increase the slack in the overall capacity, and we think inflation should continue to come down. And that's a positive backdrop for fixed income. So as I said, we think investing in bonds, high-quality government and corporate bonds should give investors a nice, steady stream of income, and that's what you want from fixed income. Of course, the challenge is outside of making sure inflation continues to come down will be the political situation, I think, in the U.S. Not much a challenge, but a lot of uncertainty out there. The Fed did come out and say, well, if a lot of Trump's policies are inflationary, then central banks need to be careful. So that's something that we will be monitoring.
Yeah, Pierre, great snapshot. So many moving parts to watch out for in the coming year. And I think this is where we can dive into M&G's optimal income strategy, which we understand is designed to be flexible and can be adjusted to a wide range of market conditions. How does the strategy manage risk and take advantage of opportunities in an uncertain economic landscape?
Yeah, so the optimal income strategy was launched almost 20 years ago. So we have had quite a lot of experience managing the strategy. And our conclusion is, the fixed income landscape can vary quite significantly over time. If you look at the last 15 to 20 years, there have been times when interest rates were very low. They were at zero or even negative in Europe. And that for us typically is an environment where you have to be a little bit careful on government bonds. And then we saw in 2022, inflation picked up again. And there was a big drawdown in fixed income. On the other hand, there have been other times when markets were worried about recession during the global financial crisis, during the Eurozone debt crisis, during the energy crisis of 2015, or times when there was issues around China. You had the COVID crisis. And that, when markets are fearful like that for a recession, is a great time to buy investment-grade corporate bonds or even more risky high-yield corporate bonds. And your returns, based on your overall fixed income positioning, can vary quite dramatically. So having a flexible strategy that can go from longer-dated, very safe government bonds to shorter-dated, more risky high yield companies, is a great way to navigate these markets. I think the difference between fixed income is based on how you're positioning, your returns can be quite different. And sometimes in equity markets, that's not really the case. So it makes the asset class very, very interesting and gives active managers quite a lot of levers to pull to generate returns in different market environments.
Yeah, that's a great point. Let's dive into that flexibility now. Walk us through perhaps some of the examples, some of the real-world scenarios where M&G's optimal income strategy would adjust its exposure to government and corporate bonds. For example, how does the strategy shift in times of economic growth with low inflation versus when growth is weaker and inflation is more persistent?
Yeah, so I think the recent COVID episode probably is a good example of how extreme environments can go. Of course, in March 2020, you had the emergence of the virus, and there was a big sell-off in equity and in bond markets. And at that point in time, we went into corporate bonds. We increased our allocation to corporate bonds because unless you think defaults, bankruptcies are going to increase massively, if you buy high-quality multinational, if you buy the debt of those companies, high-quality companies, then more often than not, when markets are risk-averse, you will do well. So that was a good example of how you can opportunistically increase risk within a bond portfolio to take advantage of those uncertainty or take advantage of the fact that investors are very fearful. And then maybe in 2022, that's when inflation kind of started to come roaring back. And initially, central bankers were saying, oh, don't be worried about this spike in inflation. It's transitory. It's temporary. We were a little bit concerned that there was a lot of demand for services and goods, and that demand wasn't being met by the production capacity of various economies. We thought that was going to be inflationary. So we reduced the overall maturity of the bonds that we held in the portfolios to protect, to behave more like a cash-like strategy, to protect investors. And that was the right thing to do as we saw interest rates and yields increase quite dramatically in 2022 as inflation came roaring back, as Russia invaded Ukraine. That also exacerbated some of the pressures in the energy market. So I think those are two good examples of how in a relatively short space of time, you can go from one environment to another dramatically different one.
Yeah, I suppose that resilience is what lends a lot of strength to that strategy behind the M&G Optimal Income strategy.
Yes, that ability to go from, very short-dated instruments to longer-dated instruments, duration, which is a word you might hear a lot in the bond markets. But there are times when, like today, we think actually, yields are relatively high. 10-year U.S. Treasury yields at 4.6, or even in Australia, to some extent in Singapore. Interest rates are elevated. Yields are attractive in our view. So you want to lock in those yields for longer. And that means buying longer-dated bonds on the assumptions that, interest rates are going to normalize in the future. So if you lock in those elevated yields for longer, then your performance should be better as interest rates come down. You'll make a nice capital gain. In addition to that, you'll generate attractive levels of income. So moving around that duration or the maturity of the instruments that you own within the portfolio, again, is a great way to add value for our client.
M&G Investments Optimal Insights on Money FM 89.3, connecting the dots globally to bring you investment opportunities.
Now, Pierre, let's talk about M&G's optimal income strategy when it comes to exposure across different markets, different regions. And when you understand that includes the US, Europe, Asia, and other emerging markets, how important is global diversification in the current market climate? And how does this international exposure enhance the strategy's ability to deliver stable returns for investors?
Yes, it's very important, and probably even more so today than in the past. So I guess in terms of the optimal income strategy, we do have a bias, first of all, towards developed markets as well. So that's just something that we've been investing in for, as I said, over 15 years now. It's also a currency hedged strategy, and we think that provides a smoother risk and return profile for our clients over time. But in terms of the geographical allocation, yeah, as you said, we have moved the portfolio around quite a bit. There were some times, like in 2023, when we thought there was more value in Europe and the UK. Today, we're a little bit more biased towards the US because, again, that's one of the highest level of interest rates in the world. Yields are quite high. But that ability to move the portfolio around is very important. And historically, the strategy has done well in, again, delivering returns by adjusting our geographical allocation over time. And as central banks decouple as well, or continue to decouple in 2025, as we mentioned previously, central banks have been cutting rates all over the world, but we're probably going to see more differentiation in 2025. Economic growth remains relatively resilient and strong in the U.S., so it might be a little bit more difficult for the Federal Reserve to cut interest rates significantly. Outside of that, if you look at Europe, a lot of European policymakers at the ECB have been saying that the ECB needs to cut rates faster to support economic growth. So as those divergences increase, there'll be more opportunities to generate, again, returns by shifting the portfolio's allocation from a country and from a regional perspective.
A lot of opportunities indeed. And we talk about how it's flexible, the M&G Optimal Income strategy. So a lot of levers you can pull, so to speak. So when you go into 2025, how are you positioned this year? How would you say is different from the conventional investment approach and the rationale behind what you're doing this year?
I think how we're different is we're probably a little bit more cautiously positioned than some of our peers or our competitors. We think right now a strategy biased towards high-quality government and corporate bonds is the right way to go. We don't want to take too much risk by investing in lower quality companies because we don't really think we're being compensated for that risk. And that echoes to the equity markets as well, where maybe U.S. equities or investors aren't really pricing in any sort of recession risk or any sort of risk of an economic slowdown. And we're not necessarily saying that there's going to be a big recession or a big economic slowdown in the U.S., but we think, when interest rates are high or given kind of the geopolitical uncertainty, markets should price in some sort of recession probability, and that's not priced in. And that causes us to be cautious on a lot of the risk assets out there. And on the other hand, as I said, you can generate, in our view, high single digits, potentially double digit level of returns if the Federal Reserve cuts interest rates maybe to 3.5% over the next 12 months without taking a lot of risk, just by buying longer dated, high quality government and investment grade corporate bonds. So that's how we're positioned today. It can change quite quickly if markets move in one direction or another, but historically we've always been quite flexible. But today that's where the risk reward is: high quality, longer dated government bonds and corporate bonds. We think you can generate, quite attractive levels of income and total returns without taking too much credit risk.
Now, lots to look forward to when it comes to 2025, and also a lot to look forward to for M&G in terms of building on its recent success. So before we let you go, M&G Investments recently won the Asian Private Bank Award for Global Bond Intermediate to Long Term. How significant is this recognition for M&G, and how will M&G continue to tap on this success to help investors adapt?
Yeah, so we were, of course, quite pleased for that recognition. I think it highlights, well, first of all, the consistency of the investment process, how the fund management team has been able to add value over the long term. But even in terms of M&G's development in Asia, it was also a good recognition, the fact that we've been present now for a long time, that we have built trusted partnerships with the private banks, or even this strategy is available in the retail space now in Singapore. So it's just a continuation of a lot of the efforts that have been made, and it's never unpleasant to get recognized for the hard work, right?
Opening up more opportunities for investors. Of course, the right bond strategy often can give you stability and value. We've been in conversation with Pierre Chartres. He is the investment director for fixed income at M&G Investments. Pierre, thanks for your time and insights.
Thank you.
M&G Investments Optimal Insights. Brought to you by M&G Investments. Intelligence Connected.